I'm Jerry Solomon, recently retired Vice President of Operations of Marklet Ward United, a division of Barry Way Miller Incorporated. I'd like to share some of my experiences and observations based on almost 4 decades of practice in lean and lean accounting. I'd like to start with a high-level view. What is lean? When we think of lean, we've been taught that there's 6 pillars. The first pillar is elimination of waste, which is where we utilize the lean toolkit in pursuit of perfection in safety, quality, delivery, and cost. The second pillar is all about respect for people. It's about inspirational leadership, where we have a profound cultural and organizational change that's required of our companies in order to have a successful lean journey. So my question for the audience is, when you look at these 2 pillars, is this really the way lean is implemented in terms of having an equal emphasis on the 2 pillars, or is this merely lip service? My experience is that this picture on this slide more accurately depicts the way lean is implemented. And then many of us wonder why a successful lean journey eludes most of us. On the left, where we're focusing on elimination of waste, we emphasize the number of kaizens or events. We typically focus on the shop, and alignment across the organization is lacking. On the right, we continue with a command and control environment. We have layoffs. We continue with silo organizations rather than value streams, and we continue with our standard cost systems. A successful lean journey occurs when the respect for people pillar is emphasized, when people are truly valued, when they are continuously leading and making improvements in their respective areas, and when leadership is there to support everyone else, demonstrating that the organizational pyramid is truly turned upside down. A true lean journey is when everyone is continuously improving every single day. So when we talk about respect, my question for the audience is your financial information respectful to all of your customers? Because that's what it's about. It's all about respect. I'd like you to think about a few questions. Do your financial statements and reports make the numbers easy to understand? Do they promote lean behavior? Do they illustrate lean benefits? Do they provide actionable information in a timely manner? Do they promote alignment between manufacturing and accounting? I focused on the 2 pillars in the previous slides as I wanted the audience to understand that lean is about respect for people and emphasizing that, and to make you realize that respect applies from a financial perspective as well. I've been doing lean accounting classes and lean manufacturing classes for over a decade. And based on the feedback from thousands of people across hundreds of companies I encountered during my workshops and speeches, the answers to the questions on the slide is an emphatic no. And I'd like you to think about it in terms of accounting being a supply of a product, and that product is financial information. And one of the customers of that product, operations, generally does not have much of a say in the specifications of that product. So again, my question is, where's the customer value proposition here, and why is that the case? Lean improvements, as we go through the journey, will initially be invisible to accounting, and I'm going to demonstrate that in a couple of minutes. Our typical manufacturing metrics are outdated and typically promote non-lean behavior. And the greater the initial success with lean, the more likely earnings will negatively be impacted, and that's all else being equal. It's critically important to understand why people sometimes have much difficulty understanding the improvements taking place. And because of those first 3 bullets, that lean improvements can be invisible, we have the wrong metrics, and earnings can in fact go down, even with lean successes. Because of all of that, accounting is often one of the biggest roadblocks to a successful lean journey. And when I say that, it's not that accountants are not good people trying to do a great job as best as possible. But one of the key elements of their job is to predict results. And when they get surprises at the end of the month or at the end of the quarter, and of course we always know surprises in accounting are negative numbers, and when accountants cannot explain why they arise, despite all the good things they hear happening in the shop, there's a disconnect and there's confusion and there's frustration. And that's why we have to align everyone, both in operations and accounting, on this lean journey. When we talk about lean, I think we all know it's strategic and it's a huge competitive advantage. And as I said, the benefits are mostly invisible to accounting. And it's also a program. It's not a program of the month. And what it's not a cost reduction program, which I will demonstrate shortly. What a lean is, it's a cash flow generator, it's a customer service program, and it's a capacity generator. And most of all, it's a people system. Naturally, overall costs and working capital will certainly decline as we're successful on our lean journey. However, there is a very important distinction to be made. And I'm going to do that in the next few slides. So the biggest benefit of lean is based on how the improvements above are utilized across the company. Okay, let's go through a little example here. Okay, my computer is cooperating. If you consider a company that we'll call a traditional company that's making a product, we'll say they're making dry erase markers. So they're making the plastic cases, they're doing injection molding, and they have an operating profile where they come into work each day and they do a 2-hour setup, which is the first horizontal plane in this chart. Then they run for 6 hours, and during the course of that one shift operation, they produce 512 pieces. We have another company that's the lean company that started off the same way with the same equipment, but they decided to go through a continuous improvement program. And they started first with 5S, or industrial housekeeping, and they reduced their setup time from 2 hours to 1 hour. And their operating profile changed. When they came in for that one shift operation, they went into setup for 1 hour. They then ran for 3 hours, produced 256 pieces, then did another setup for another hour, ran for another 3 hours, produced another 256 pieces, and therefore produced 2 different colors, 2 SKUs in the 8-hour shift. They continued down the lean journey for a number of months, constantly getting better to the point where they got to 7.5-minute setups, which is about midway through that chart. So in essence, they were doing 16 setups a day with a lot size of 32 and producing these dry erase markers in a variety of colors each and every day. They went through distribution, and they were really satisfying their customer base in terms of different ways they packaged the dry erase markers, different color configurations. Their deliveries, very short, on short notice, were 100% on time, a lot of great things. Now we step back, and what does this have to do with accounting? What this has to do with accounting, what if you were sitting in accounting and at the end of the month or the end of the day or whatever the reporting period, you were looking to see how did this cell perform or this company perform, whether it be traditional or the lean version. And I tell you that from a cost accounting point of view, the performance would be exactly the same with the traditional metrics, whether they are efficiency, utilization, or productivity. In any time period, the input or the amount of labor would be exactly the same, and the output would be exactly the same, 512 pieces each and every day. Therefore, traditional measures of efficiency, utilization, and productivity would be the same regardless of looking at the lean company or the traditional company. And what we're ignoring here is the metrics of flexibility, working process, quality, customer service, and all those things that we improved during the lean journey. So this is one of the reasons why the improvements that happen in the operations are invisible to accounting. One thing I said on the previous slides were cost is not the first objective of a lean journey. We do safety, quality, delivery, and cost in that order, SQDC. And many companies go down the lean journey, and they might have a tendency to say, let's reduce costs in the next 90 days. If one were going about this to reduce costs, the danger would be if they reduce setup time from 2 hours to 1 hour, that they might just come in one day and say, let's do a 1 hour setup, run stickers, produce 512 pieces of one color, and then send people home by saving 1 hour of production. That's the danger if cost is the first objective, uniting the benefits of lean in all the other areas. So let's briefly review the cost system I would guess most of the audience uses. A standard cost system or full absorption costing where all costs incurred in manufacturing processes are assigned to specific products, which is the system of choice for most companies today. Okay, if we look at a typical plant cost structure, how did it come about? Excuse me. Many decades ago, or almost 100 years ago, when people came off farms during the Industrial Revolution, the cost of goods sold pie chart was labor was 60 to 70% of the cost, material was 20 to 30%, and overhead was 10 to 20%. So our cost systems in the early 20th century made sense. It was mostly touch labor. And while we didn't exactly know how to account for overhead, riding the backs of direct labor made sense because it was immaterial. If we fast forward today, our cost structure is very different. Material is the majority of costs at 60%. Then comes overhead, and I'm being generous when I say only 30%, because I've seen it multiples of 4 or 5 of direct labor, and direct labor is 10%. So as times have changed and processes have changed and variety of products we produce have changed, our cost systems generally haven't changed. We've focused on removing direct labor for decades, so now direct labor is a fraction of what it used to be. Costs have shifted to material and overhead. So let me give the audience a few things to think about. Does it still make sense to cost things today as we did almost 100 years ago when the cost components in manufacturing processes were drastically different? Can you really allocate today's overhead, such as supply chain, tax insurance, building depreciation, manufacturing engineers, to the SKU level based on direct labor content? Can direct labor be applied by SKU or operation if you are truly going lean and one person operates multiple machines while people are constantly moving about in the cell? I venture to say it would be very difficult. In the standard cost model, direct labor is treated as a variable input that changed in lockstep with production. When in reality, if you graphed your direct labor for the last year, I would venture to say it's closer to a fixed cost. Likewise, overhead is treated as a variable input when it's the multiple of direct labor. Yet it also behaves like a fixed cost. And lastly, most people do not understand the full cost P&L, especially those charged with improving results on the shop floor. So these are just a few of the potential deficiencies of our current standard cost systems. And part of the proof is in our overhead rates. We keep reducing direct labor and overhead rates go up because of linked to direct labor. During the course of my speeches and classes, I wanted to see what practitioners thought about their costs, and in particular, how accurate they are. I queried people about what goes into their rates for overhead, how are costs spread, how accurate are they, and based on my surveys of the difference of cost, I got these results that by and large, every material, that's case scale, is 90% accurate. Therefore, the weighted accuracy is 54%. And continuing down this chart, direct labor people felt were at best was 60% accurate. And I usually got a lot of laughs, and they stretched their imagination to say that overhead, and again, this is at the SKU level, in their respective cost systems were about 30% accurate. So when you put it all together, the cost system accuracy is about 69%. When I did a personal deep dive, it yielded similar results. The bottom line is our system-generated costs are wrong and can lead to poor decisions. So why does the standard cost model frustrate operations, particularly during the lean? Because our typical performance measures are financial, not predictive, and they're late. And they motivate inappropriate behavior as relates to the lean journey. They do not typically identify waste. They do not identify obstacles to flow, and they do not demonstrate lean improvements. I want to take you through a very simple example of a 4-step operation spread across a large facility. And the 4 steps are we go through a 2-minute drill operation, a 4-minute milling operation, a 6-minute assembly operation, and 3-minute pack operation. There are other metrics here that I'll get to shortly, but they don't apply to the cost question. My question for the audience is, what is the cost to complete 1 unit, given the cost structure in the box on the lower left, where direct labor is $30 an hour, overhead is 3 times direct labor, and material cost per unit is $10 per completed unit. So again, what is the cost to complete 1 unit? And of course, it's a rhetorical question, and I'll let you off the hook and go through the answer here. As you'll see, it takes 15 minutes for the process to be completed or the product to be manufactured. And given that direct labor is $30 an hour, it comes out to the cost of 50 cents per minute. Therefore, the total cost for direct labor is $7.50, or 15 minutes times 50 cents per minute. Our overhead is 3 times direct labor, brings to $22.50, and our material is $10. Therefore, the total to complete 1 unit is $40. Now we're going to ask operations to, we're going to challenge them to improve the performance, because we have a lot of problems. The operations are spread all across the building. So we asked them to create a U-shaped cell, get right-size equipment, co-locate everything, set up Kanbans, reduce the lot sizes. So they do what lean experts do. All of these things, they balance the line a little bit more, and they set up a full system. And here's what they created: a nice cell. And the times for most of the operations, or some of them, have changed a little bit. As you can see, they actually slow down some of the operation as well. And as we'll see on the next slide, all the operating metrics have improved dramatically. So let me go back a second. So in this one, they reduced the lot size to 300 pieces. The average inventory was down to 500 pieces. The lead time went from 8 weeks to 2 weeks. And OTP, which is on-time performance, went to 95%. So if I show a chart before and after of what really happened when they located activities, co-located activities in a cell, right-sized, and balanced the process, you see inventory had 90% improvement, lead time improved, and all of those metrics, operating metrics, customer-facing metrics, on-time performance, quality, improved dramatically. Operations summarize the results, and they're pretty happy. Actually, they're extremely happy, and anyone would be with improvement. What happened in the new layout? We slowed down operations. So now if one would go look at the accounting records and add up how many minutes are spent at each of the operations, the total time would be 18 minutes. And if we have the same cost per minute for direct labor of 50 cents per minute, we have $9 of direct labor. And because overhead is 3 times direct labor, we therefore have $27 in overhead, $10 in material, and the total cost now is $46. I'll give you a few seconds to take a look at that chart. So the accounting records will say that costs went up, and why? What's really happening? I'd like you to think about that for a bit. Why did costs go up in this model as the time went from 15 minutes to 18 minutes? And the answer is, as operations slowed down the line, less WIP, work in process inventory, was being generated. And lower WIP results in lower absorption and perceived higher costs in the system. So now we have one metric, a critical metric, cost, indicating that the improvements were a detriment to the business. While everything else was favorable, manufacturing still high-fiving each other, accounting is saying costs went up 15%. So operating folks are happy with their successes. They think things are going backward. And this is a huge disconnect between key areas of the organization. And typically, the other operating metrics are not captured at local level, so there is a lack of understanding about real improvements. Now, one last thing that's not filled in the chart, I'd like to turn to throughput. After all, the top line of any P&L is revenue, and that is dependent on how many units can be shipped. In both cases, how many units can be shipped per hour? And I'll bring back one of the cells and how it looked. I'd like you to think about how many units can be shipped per hour. I'll help here. Since the bottleneck operation is 6 minutes, and if that was the case in both situations, no matter what else happens in the cell, you only produce a completed unit every 6 minutes. Therefore, the most you can do is ship 10 units per hour. So before and after, the top line of the P&L is the same. Revenue is going to be the same. Okay, so we have, again, the completed scorecard. Revenue will be the same because we're going to ship the same amount. Before and after metrics, all of the operating quality metrics have got dramatically better, but the metric that's gotten worse is cost. And this creates the problem or the possible roadblock we see in the lean journey. And this is why it remains invisible to accounting, and why accounting and operations must work together during the lean journey to develop lean metrics. Okay. On the next slide, I want to bring up one of the traditional metrics. I indicated that sometimes traditional metrics promote non-lean behavior. So I want to bring up one that we're all familiar with, and that's purchase price variance. Why can PPV motivate anti-lean behavior? And if you look at the slide, and I've seen this, I've drilled down at companies, why did we buy the quantities we did, given the production schedule, talk to the people that did the purchasing decision, and while people don't like to admit it, PPV promotes buying excess inventory due to quantity discounts. We also shop around for a lot of suppliers and look for low bids, which may compromise quality and delivery over price considerations. And when we do shop around and increase the number of suppliers going in the exact opposite direction that we like for a journey, which is to partner with our suppliers with a long-term relationship and have a win-win situation. But what might we do instead if we're not going to track PPV? How about tracking actual prices over time and monitor trend lines rather than performance to an artificial standard? Those are the things we have to think about. What behavior do our traditional metrics promote? How do we make these lean improvements visible? As we physically change the processes during the lean journey, manufacturing and accounting must work together to transition to what we call lean accounting, which is a new set of financial statements in plain English. And we say it's in plain English because we eliminate standard costs, absorption, and variances. Because quite frankly, a lot of people do not understand what those are. And it's a new format that makes it easy for everyone to understand exactly what's going on. We create box scores which illustrate the improvement in both the financial side of things, but also the lean operating metrics, and most importantly, in capacity. And we develop what we call value stream costing, where we cost at the family level rather than at the SKU level, recognizing that SKU level costing is incorrect and may lead to bad decisions. And lastly, we focus on cash flow, which is obviously the most important thing in any business. Okay. It's not advancing the slide.
Jerry, try right-clicking on it and going to the next slide and see if that helps.
So suggested next steps. Okay. Suggested next steps for the audience. See what it goes into a loop, and it hasn't done this before. Okay, I'll give it a second. First, you need to become a believer by doing two things. And first, I'd ask you to talk to your manufacturing peers and ask if they are frustrated with any of the accounting reports. Second, do a deep dive into your standard costs for a few key SKUs and determine how accurate they are. And by that I mean, go into your actual purchase of cost for any item. I'll just do this verbally. Go into your purchase cost for any item and look at what you paid for it. Look at what the freight was to bring that item into your company. And then look at the overhead that's being charged through all the allocations and see if they bear any resemblance to what the cost is. Next, I would suggest you go in direct labor and go out into the shop and see what exactly the time is taking to produce this item and put it together. And you will see that at best, you're only within 60 to 70% of true cost. Next, I would ask you to look at some of your current metrics and do a value proposition. Ask who uses the metric, who in your company really understands it, and what the accuracy of the metric is. I'd also ask, what is the cost associated with measuring, collecting, and maintaining the data for the metric? And does the metric promote lean behaviors? So doing a few of those things would be beneficial for you to really get an understanding of how good your cost systems are. Okay? And last, I'd just wrap up by really building an alliance with the operations people to develop a scoreboard that is supportive of both the lean journey and making sure that this scoreboard has a balance of financial and operating metrics, and have the manufacturing jointly anticipate the financial impact of lean initiatives by understanding exactly what they're going to do and what the impact is on inventory, because any reduction in inventory will reduce earnings, all else being equal. And then, as a team, you can really anticipate what's going to happen. We won't have just one group of people high-fiving. We'll hopefully have everyone high-fiving and really feeling good about the journey and developing a true alliance between accounting and manufacturing.